So Semil founded Haystack VC. Haystack has backed companies like Figma, DoorDash, HashiCorp, Instacart, Applied Intuition, and a bunch of others that I'm forgetting that have gone on to do quite well. And I think many of you may have seen Semil doing some talks actually before he was a VC and was actually more on the reporting side. And so I think it's just, he's got a wealth of backgrounds. We're very excited to have him here. So, the first thing I know you have a viewpoint on, because you've actually sat in the multi-stage fund rooms. Yeah. You then have done your fund, at the earliest stages. Yeah. And I guess for everyone in this room, right, we got this major David versus Goliath thing happening in the industry right now. The round size are huge. AI seems to continue to push things towards, more of the multi-stage funds doing things earlier in the first rounds. Mm. But then again, you're still doing the job. You're still backing companies. You're still finding them. So just walk us through that dynamic. What are you seeing? What should we be aware of in this kind of environment from, kind of this seed, pre-seed, early stage perspective? Yeah,
it's definitely you just hit on the major challenge I think me and everyone in this role faces. I think it's do you believe that all the big funds are going to catch all the important companies early? Or do you think all the accelerators are going to catch all the important companies early? Or is there things falling through the cracks? And I think we'll know in a few years. But that's sort of the eternal question. I think a lot of LPs may think, oh, well, it'll just funnel up to the big funds and they have coverage. Or a lot of people will think I'll just go the accelerator route and they'll cover all the things. I don't think we really know yet. There's no pattern. But at least from our point of view, there's still a lot of people doing native AI, let's say applications or infrastructure, where they've had some exposure to native AI systems in their previous job, and they're technically gifted enough to do it, where they're raising $3 to $5 million. So they're still doing that. Maybe they wanted to raise 10 or 20 and they couldn't, or maybe they wanted to get into an accelerator and they couldn't. But I think we'll know in a few years.
One thing though I have a question is just you have done both of these. You've participated in rounds alongside the multi-stage funds, and then you've also led. And I'm kind of curious on your thinking around that. Is it just truly just getting to the best deal, or is there something?
Yeah, I think the thinking around keeping the fund size relatively small. I started Haystack with $1 million fund, and now we're just investing out of an $85 million fund. So to me, it feels like a lot of money. It seems like 10% of certain rounds that are happening now is $85 million. Which is kind of bizarre, but my approach has always been to be more collaborative than competitive. So if you stay smaller, you can collaborate more, and then there's less pressure on your portfolio construction. The smaller you stay, again, you still need some, or you need more, but and then also being able to say yes more often and not worry about the contours of it or the shape of it, where you have a little more latitude to go off script. Yeah.
But then, LPs talk a lot about ownership. And so how does that work in this dynamic?
Again, I get more philosophical about this, having been through the ringer here, and I know, where's JD? Yeah. What's up? JD was one of the more gentle LPs I had met during my sort of trails. But I think it's the line I come back to is in politics, the more you're talking, the more you're losing. And so what I mean by that is, if you don't have your own point of view and your own access to capital in some way and your own access to founders with the point of view that you believe in, you're just going to be on the receiving end of LP questions, and they're going to ask you the same standard set of questions. And then in order to get the money, if you're desperate, you'll just start believing that that's what you should do.
Starts dictating the strategy.
Yeah, so I can buy 10% of a lot of companies that are turds, So I think what really matters is the selection against it, and doing it commensurate with your fund size, so that you're essentially, as an investor, as a pre-seed or early stage investor, what you're doing is you're building a basket of options for your LP in a way. And so you cannot control the outputs, right? You're not on the boards usually. You're not a control investor. You don't have a lot of leverage. You can get squeezed out. So really you have to give each basket multiple paths to victory if things work. That's really the job.
Well, you mentioned not talking as much, and one of the things I've noticed is like, you used to be prolific blogger, used to be doing a lot of podcasts. Recently, you've been more of a retweeter and not doing as much. And I guess like one, is that a active strategy on your part? I also noticed we don't have a breakout company for this year, I think.
I stopped doing that.
Okay.
Yeah, because like I did OpenAI for 2 years, and I was like, what's happening here? There's no breakout startups.
But I guess like the question is that you just being like, hey, I've already built up my audience, and so now I don't need to, or what?
No, I think part of it is just like having something that I really want to say versus like maybe I haven't had something I want to say in a while, but I'll be back, I just think of it as like it's very noisy, and like if I don't feel like I have something to say, I don't say it. Yeah.
But like when you were starting out, I would assume you were saying much more because that was helping build the brand. Like
it was it wasn't to build a brand. It was literally like I call it like a vowel movement. It was my way to like process and learn how to interact in this world because I don't come from this world. Yeah.
Said differently, should other people be thinking about vowel movements?
I do think one of our largest LPs, she's now retired, but she'd been doing it for like almost 20 years. And she did a panel with us with a bunch of pre-seed investors a few years ago where she basically laid out and said, us as LPs, we watch your social media, we watch what you say, we watch what you write, it all becomes part of the record. And she would actually encourage young investors or any investors to actually do that because it becomes part of your record. So it's funny because she said that to a group of people, and I don't think the people did it. So I think there could be multiple motivations. Like mine was just to like acclimate to the world, and it just so happened that it resonated with a lot of other people, and I like writing. But I think for other people, I know a lot of people who have ghostwriters or who have like doing it on a schedule, and I have a friend who's starting a podcast. And again, I think all that's great. I think to what end? And if you're spending 8 hours a month doing a podcast production and you get 117 views, should you have been meeting an entrepreneur during that time? It just depends. Yeah. I don't like giving advice that way too, because it doesn't really matter until you're in good deals. Right? Like, yeah.
I guess that goes to when you think about, so to speak, positioning. Let's say like, it takes time for so-called good deals to manifest, especially at the stage of everybody that's investing in this room. And so I guess like, how do you think about that sort of positioning that you want to bring to the world? Because you do have to have something opinionated to get the founders to come to you, to have the LPs attracted to your capital, so on and so forth. And maybe the answer was you had that with Haystack from what you were writing, but I
don't think my story is like instructive for
Okay.
other people because it took a long time, and then I just made the decision to like get to know a lot of them, learn, and then ask them like what they needed help with. So I got them into deals, I got them into funds, and then like things flipped. Like I got my first real institutional university like handshake and yes 6 years after I wrote my first check. So most people won't wait that long. And also post-COVID, it just flipped. Now I have a WhatsApp group with 4 LPs that's more of a social group, but they just want me to feed them people doing funds under 25 million. And I was like, where were you guys 6 years ago? Or actually 13 years ago.
What do you think about this dynamic of it was kind of like more 2020, 2021, where you had these, or maybe 2019, where you had founders that were running companies and then were starting these angel funds on the side. Mm-hmm. And, then we went through the flip side of that, right, where that kind of started to dry up. And now it seems like we're kind of almost back to that again. Is that a sign of excess, in your opinion, or is that just how the world works?
I just think my answer to that is broad, which is every year I've been doing this, which is I guess I'm on my 14th year. There's more companies in the denominator. There's more money chasing it, and there's more like high quality founders. So if you have those conditions every year, these are just natural consequences of that.
Okay, so there's no signal, though, that you would read into it that, like, hey, we might be 2020, 2021 all over again.
If that's a question you're asking, which I think is like a different question, I don't know, because actually the multiples people are paying now on forward revenue in private markets is actually, as someone told me, it was like 80-something X, versus like in 2021, the median that they were paying forward was like 110. So you could rationalize it's not as bad on a relative basis. But there are, I would say, like behaviors that investors, like I'm sure you're in group chats where you said, oh my God, I heard this thing, and you go, that seems not right. And I think that happens multiple times a day. Yeah. So it's out there for sure. Someone described it to me as like, everyone's trying to grab a bag right now. Yeah.
Which I think is maybe the time to do it because of AI actually taking our jobs or something. But it does seem like that's what the young people are talking about.
And I also think there's like a lot of recursive advice both sides of the market are giving each other. You have a lot of founders talking to other founders and being like, you don't need a deck, you don't need a blurb, you don't need anything, you just need this, and like you shouldn't raise anything less than 10. And then you start hearing that in the echo chamber, blah, 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 blah. And on the other side, you say, well, our funds, they need to be double in size, and we need to be in this company, and like we should just pile into the winner. And all of a sudden you have 3 rounds in a company in 1 year, right? So both sides are talking to themselves and sort of like, the advice is reinforcing greed, basically. Yeah.
You know, one of the dynamics you talked about there is like the king-making aspect that we're starting to see, and I think it's always been there, but the extent to which it's happening now seems to be, or I guess the level of capital at which that's happening now seems to be very different. And I guess my question is how are you thinking about the positioning? Let's just make it like your king-making cursor, right? So, should someone be do you think there's still opportunity to find the cursor 2.0 that could become a breakout company, or is it just like the oxygen has been sucked out so much from the larger funds taking this that you may not be able to attract the capital needed to go in and scale?
Yeah, I mean, I think if you use cursor as an example, it'd be like a tough thing if someone like knocks on your door and is like, "Hey, we have a better cursor." It's like, okay, like let me know when you do. But
True.
I do think the sands are shifting so much that things will change, and so what's fashionable today may not be fashionable in 6 months, or maybe obsolete in 6 months. I do think that's a possibility. So. It'd be interesting to know, like, I don't know this, or like people liquidating in these rounds too. Are these actually the rounds, the liquidation rounds, that where you actually make the money in the run up? Who knows? I don't know.
What about, you have a pretty wide portfolio, and I think one of the interesting things is you've specifically maintained to be a generalist versus the specialist trend that has, I think, been permeating. I mean, you see the multi-stage funds are doing these pod structures now, right, like hedge funds. And so I guess my question to you is like, is there still room for generalists in this world? And also, how do you need to position, though, as a generalist to win in that sort of world where you have these multi-stage funds with these pod structures?
Yeah, I mean, part of it is not really a strategy, it's just who I am. I couldn't specialize like in anything, I don't know what I would specialize in. So part of that is just like who I am. But I think I have friends who are kind of doing that or experimenting with it. And all I can answer is like what I tell our LPs, which is like we're generalists. We meet people who we're going to meet. We can't meet everybody. And we try to build relationships with the people that we want to invest in, and go from there, and like have a lot of shots on goal, right? We'll have 30, 35 names in a portfolio.
But like, I know.
But I think like the specialist trend is actually tricky on the LP side, because if you tell them that that's what you're doing, then they'll expect that, and then you have to be in the winners in that. Or if you deviate from that, they may say, well, I don't want to buy that, versus like we're upfront, like, hey, we don't know what we're doing. We don't know which way this is going, and look at all of our data, which is very consistent, and you decide. So then it becomes like we can do anything we want.
But would you argue that if you're going to do that approach, like, Ashay's told me he's been looking at like bio stuff and things like that, right? And like, that's a very hard competency to build. So would that be that as a generalist, you need to build a much broader network to then be able to diligence this sort of stuff and go figure it out, or is that not your viewpoint?
That's not my viewpoint. I think Ashay is going through what I went through earlier in my career, which is like you want to feel like you have some control over what the outcomes are, what you can invest in. And I've just found the reality is not that. But yeah, you can be thematic, or you can do research, or he's a curious guy, so you can like kind of look at an area. But ultimately, our portfolios are just a reflection of who we actually bump into and spend time with.
Okay, so let's take the meta question there then. So we don't have control. We're in a simulation, right? But I guess like if you cannot control that, then is it just increase the surface
You
area
can
of
just
how you can get lucky?
control the inputs. You can control the goodwill you put out. You can control who you spend time with. You can control who you take a first meeting with. You can control what price you're willing to pay. You can control what your median check size. You control all the inputs. But I think, and then you have to account for them with your investor base, right? Like, why is your mortality this? Well, let's pre-seed. Okay, what happens with the other ones? Did you make the right choices in them? And you just have to be willing to stand behind those choices, right? And the beauty of having the smaller fund is that, like, you could still have an $850 million exit where you own 10% at exit, and it can return the fund. But you have to make that happen. Yeah.
Yeah.
Not everyone is going to catch Cursor like Neo did. And I don't know what the Neo position is. I don't know how big the fund is, right? Someone told me the other day that, like, of one of the big model companies, a growth fund that did a round at $4 billion. I won't name the names, but someone can infer their current holding position with the dilution going from, pretty sizable uptick, is like 4x the fund on paper.
Just
right.
from the markup, okay. It's a pretty crazy world. So let's talk through some of the actual things that are happening with AI. And one of the things that I'm curious about is, I guess, has this changed, though, some of the sectors that you would look at? Like, I at one point, you were looking at a bunch of like dev tools and infrastructure stuff pretty deeply, right? And would you say that like and I don't mean to pick on that, but in general, like, is there any sector or area that's changed with like how AI is permeating through this world?
I mean, I think it's the same things you would say, which is like the coding related stuff. Or I actually think infrastructure is interesting in this way because you do need some orchestration between the systems you use. So I think that's TBD, but not really. I think the main thing we try to avoid is like we'll see things come in waves. So I think in this year, in 2026 already, we've seen from good friends sharing with us 4 teams with real estate kind of related operations and investment backgrounds trying to bring AI to their world. And it's like, well, how do we pick from the 4? And also, like, are they going to be fast adopters or not? So it's been mostly like exclusion rather than like focusing on. Yeah.
And what about this dynamic where I think there's been that traditional thing where like it was a partner that was saying, hey, momentum is the moat or something like that. Speed is something like that was the thing. I guess let's start there. What's your take on that?
I agree with that now because you're starting to see teams, and just a lot of the creative people I know are able to do a lot more with little now. So I do think like taste and the speed of like iteration and execution is the thing to back, almost regardless of the industry, because if you find that 100x person, they might be 1,000x with today's tools. Yeah.
So then does that mean that the new benchmark has permanently changed from, triple, double to now like 1 to 10 to 20 million first year?
We have a few companies where like one company is going from 25 to 70, but not a native AI company. And he's like really bummed out that like growth investors are like poking holes in what he's doing. He's like, hey, come on, but that's reality. And that's at growth. I think at seed to A, there's just a bifurcated market, right? If you're not doing a native AI startup, you have to go raise from a different set of investors who are more broad, who are doing both. And then if you do cast yourself as a native AI startup and you're not going, 0 to 8 plus in a year, they'll say, well, are you really an AI startup, or are you just playing around? So the bar on that side's really changed.
It just seems like that's not the traditional way we've thought of building companies.
Well, it's a debate, and we'll know in a few years. There are a number of investors I know at top tier funds who will say, "Hey, I'd rather." Their rationale is, "Hey, I'd rather just be in a bunch of ones that are going 0 to 8, and I don't want to overthink it." And yeah, 3 out of the 4 may not make it, but I'd rather be in them than not. And maybe the 1 out of the 4 makes it. There are other people who will basically say, hey, like these budgets are temporary and like we're in a experimental phase, and like I don't know if anyone remember. I think it was like Jasper AI. Remember the copywriting one? And they'll just say, I want to look at this, I want to look at this, and then just, and it was like the wrapper argument. It's up again?
Yeah, it's up again.
Oh, wow. I didn't know that. Okay. Well, I stand corrected then.
No, but exactly. It caught that first wave, then like that, and then they had to retool for like much more of like an enterprise motion that they could do it. But yeah, I guess these so-called Zerpicorns, let's call them. What do we do with them, right? Like, I guess, like, what is this like? Do we have to be trying to like go to PE to just be like, hey, like, let's figure something out together? Do we try and merge them to make bigger companies that can go public? Like, I mean, just what have you heard? What have you like hypothesized about?
Yeah, I don't know if this is the answer you want. My view, and we have a few of these. Everyone does. I think that, and they're actually like have revenue and stuff going. I think the question is like, my view, unfortunately, is like it's rare to find a founder where you can like have that discussion with, and that like take it home with them. My default view is like even when I have those conversations, I'm not sure the conversation goes home. And so the question is like, when do they actually face that? And the problem is like the first wave was like when the Ukraine war started and the market tanked, like that was the first warning, And then the second warning was like, hey, the AI stuff, we didn't know what Claude Code would be or Codex would be. And then 6-8 months ago that happens, but we knew it was going to happen. We just didn't know when. But then it was like, oh, wait, that just happened right now? Oh, okay. Like, what do I do? And I think the problem is like, they're still decent margin businesses and the boards don't really have control over the enterprise. And so, it just becomes like, when does the CEO or the management team feel the pressure? And I don't think they've felt it yet. I honestly don't think a lot of like the Zerpicorn CEOs probably understand what's happening in public markets, like psychologically in the last 2 or 3 weeks.
That's
when you don't need to raise capital, you're not tested. And actually, I like it when our founders, one of the reasons when people ask like, oh, Semil, it's so great, you say it's so small, and like, yeah, we could have raised hundreds of millions and I could have done all that stuff. The reason I like the smaller rounds is they have to go back into the market. And it's like, okay. And the decision of what happens is pretty binary. So I like that. But when you give people too much money, then they don't have to go to the market, and then you get the more inward thinking.
Okay, two final questions for me. One is this emergence of these high concentration funds that have basically thriving. Green Oaks, I think, would be the most
benchmark.
Oh,
and Founders Fund.
Yeah, that's true. How they changed, so. Talk through that trend, because that seems different than what we've seen in the past, and it seems that's the way they got to that they're getting to scale, right, and that they're winning founders, showing, hey, we have ultra conviction. Of course, there may be a bunch of dead bodies if you didn't pick the right ones, right? So there's the risk. But I guess, do you think we're going to see more of that? What's your read?
I think Benchmark is the most interesting example to key in on, and I'm going to use numbers that I don't know their strategy, but just from like talking to people or looking from the outside in, it seems like they've reduced their portfolio count, even though they're probably going to grow in fund size, but they've reduced the number of names in the portfolio, and they want to stay with like the momentum check. And they've been doing historically anywhere from inception to like Series B, but their mix of Series Bs would be like 5 to 6 in a fund. Now I think if you look at the data, their median check could be like 30 to 50, and they're taking fewer names. And I think they're basically saying, okay, in this market, I'd rather have fewer bets with even sub 10% ownership in some cases in things that I think could be huge, and willing to take that risk to do it. So extreme concentration, right?
So final question for me before we open up for the audience, so please get your questions ready, is basically like, for me, one of the things that I'm still trying to tune is my kind of founder read, right? And I think one of the things you've done exceptionally well is the names that we mentioned that you've backed. I guess they're all very different. Tony from DoorDash is extremely different than Mitchell at HashiCorp, right? And so there's no easy way to answer this, but like if you were to try and figure out some way of something consistent across them that you were seeing, what would that be? Or what sort of signal were you looking for? What were you reading about the founder quality that got you to make those investments?
Yeah, I'll answer it a different way because those are all people I kind of knew before.
Okay.
But I would say is like, I think a lot of people, even us GPs do this with LPs. When you're pitching and you start using lots of props, right? And it's like, becomes a show and tell where someone like drags in like a box of stuff and they're just showing you a bunch of shit. And I try to like just get in a conversation with somebody over like 3 to 5 hours and maybe over like a few meetings, like try to have 3 to 5 hours conversation. And I find out I can learn about them personally, their motivation, where they got the insights. Am I actually interested in talking to this person? And I just try to focus on that. Now it's harder in a Zoom world because everything has shifted there. So I try to use like different mediums of communication to like test like what their genuineness is. But it's not perfect because you can like founders can like game the system now. But yeah, I just feel like I don't. Eventually, if we get into a deeper conversation, you want to show me a demo of this. But I just want to know like what is the thing you're doing? How did you get the insight? And why are you doing it? And that can actually really just be a phone call. Yeah.
What in terms of though, like, is there something that you're looking for in their background, like the chip on the shoulder or anything like that, or is that?
No, I don't look. I just think like I try to read a lot and like learn about like kind of like Ashe in a way, but I'm not reading to look for investment. I'm waiting for the moment where I can connect with the founder because I was like, oh, I read this thing, or I saw this thing, or I went to this exhibit, or I saw this thing, and then I get in the 3 to 5 hours of conversation. I could talk to someone for 10 hours if I like them. So I'm just like at the end of that time, do I feel like I'm walking a circle around them? Like I've looked around the corner and I can see around the corner and they haven't, or are they walking a circle around me? And if I feel like they're walking a circle around me, then I'm more inclined to like take the bet.
Yeah, makes sense. Well, I'm sure we all have questions, so we'll turn it over to the audience to see, and we can pass the mic, or you can just stand up and say. You want to pass the mic?
Like compared to a few years ago, what kind of questions do you ask founders to get to know them in today's world compared to the questions you used to ask them a few years ago?
It's been pretty consistent. Yeah, not much different. I mean, if I'm asking them, like, if we're having a deeper conversation of how they built something, I will always ask, but I've always asked, like, what's the stack of how you put this together today? I know it can change, and why did you put it that way together? But it's not looking for an answer. It's just looking how they react and how they approach a conversation around it. Yeah.
Let's riff on that though. What about when you met Dylan, he was what, 50,
That was like really random because he lived in my neighborhood and we became friends.
Okay.
Yeah. So
but Mitchell still was young too, I think.
I met Mitchell when he was a teenager.
Okay.
Yeah.
I got it.
I mean, I knew from the first moment I met both of them, I was like, they're exceptional. I knew that, but I wasn't even an investor when I met either of those two guys. Yeah.
Hey, Semil. You mentioned that LPs are now like looking at the social media and tracking basically what the posts are and stuff like that. Are they looking at your personal posts, or are they looking more at what the fund posts and kind of the strategies
I
that they
think
take?
that if someone is cavalier enough to go on their private social media, or like, you know how some NFL or NBA players get in trouble, like they're definitely hearing about that. I think they don't really care. Like if it's a larger fund where it's like a corporate investment in like a corporation, it's just like, oh, it's going to be there. Probably the pressure's there. But yes, I do think so. Yeah. Not all of them, but I do think a lot of them do. Yeah. Because it's all the diligence is like reputation diligence.
Sure.
Yeah.
But are they also following like your portfolio through social media as well?
Some do. I think most of them just want like an update of like, at least for early stage funds, like, have you committed a lot of capital into something that's a turd, and what's actually working? Because they know that like most of the things aren't going to work.
So what's your follow-on investment strategy? Oh, hey. What's your follow-on investment strategy, and how has that changed with your current fund?
Yeah, this goes back to like the conversation we were having about like having LP speak, like invade your practice. Like a lot of people want to know when you're starting, like, oh, you wrote this size check. Could you write 10x that check? How would I know? And then it's like, oh, can you follow on? Will they let you follow on? So then you want to flex and show you can follow on. And I think I made good decisions there and bad decisions. I think during 2021, I remember one deal where we sent it to a friend at a good fund, and he just fell in love with it. And instead of doing like a $7 million round, was like, here's 17 million. And so our pro rata went from 900K to like 1.8. But for a fund of our size, that was a material difference. But we just felt like, oh, we should just go do that. So right now, the current thinking is like, we'll weight it, and we tell the LPs, like, we'll weight it to first checks and an additional shot on goal. And we'll do fewer reserves, and we'll do supportive reserves, which could be 250 or lower. Or we'll do more, or sometimes in cases where we feel like we really like it, we'll write an uncapped note on the other end of the extreme into a round. So like we did a 1.5 million pre-seed round in a kid from an alumni from a company. And we were shocked he only wanted to raise that much, so he gave us 500K of the 1.5. And then we knew we wanted to invest more. We knew he would raise like at least 5 to 15 million more. So we just made, Ashay and I just chat on the phone, made a decision. I flew out to New York, offered him it uncapped, and he spent a weekend with it and took it. But I would say we do that maybe once or twice a fund. That's a compliment. Learn from compliment.
Any others?
Hi, thanks so much. This is great. My question is, especially when you're maybe first investor, you've got a deep relationship, you've sort of backed them personally, which is a bit of a hallmark of your style as well, and they get later on in the road, they're thinking about an exit, something's really attractive. You might also be weighing what it might look like for your fund, what it is to them personally, what the growth investors underwrote for them to reach and achieve. Just, do you have any stories or tips on how to be a sort of good investor for your founder at those stages?
Yeah, I think like, I don't know, it's kind of a hokey answer, but like giving them the honest answer. Like I think if you feel like it won't be maybe a huge return for your fund, but like it would change their life, or they don't have gas in the tank, like I think it'd be pretty unethical to like force them to keep going. They may have other investors that make that decision for them, So if you do have a relationship where the founder does call you, I think it's just like trying to get in their shoes. And I guess part of the assessment is also like how much do they really have in the tank? Because they tell their larger investors on the board something, and then usually the day before and after they have a different point of view. So there's a lot of whiplash there. One of the reasons I would never start a company is it seems like that's a lot of whiplash to manage. I'm trying to think back to like specific conversations. I remember Mitchell actually came to me like one of the first times only times I've ever seen him like truly frustrated. And he said he was spending more time with VMware. They were offering him like $50 million. And, he owned at this point like 90% or 85% of the company. And he's 21, and he was like, and, I remember this conversation, and I didn't know what I was doing. I think I told him, I was like, hey, you're not going to create something else like this again, like, and you're going to be in deep Palo Alto, like in the woods, like in khakis and a blue shirt. So you go tell them that unless they give you $75 million, you're out. So he went and he told them, my investors said, I need $75 million, and they kicked him out. And that was it. So yeah, bad advice turned into a good outcome.
There's a roll of luck here.
Yes. When you're on fund one, you think about like balancing on thesis investments with like logo, like getting the right logos. How much does that matter?
I didn't think about like the idea of like logo collecting. I never knew that in fund one. I didn't know what that was. I didn't know what reserves were. I didn't know what follow-on investing was. I had no fucking clue.
Because you were around.
No, I had no clue.
But is it like a good idea?
Yeah. I think the answer is strategically it can work, and if you're building, if you think about it philosophically, okay, I'm taking money from the LPs and packaging it, and I'm building a basket for us, like I was mentioning before, but I also want to build multiple baskets, so I'm building an experience, a brand, or whatever it is that the founders can interact with, then I think you can absolutely rationalize a logo collection. So yes, but I think if you're just doing that, then you have to ask like why. Now that being said, you could in 2022 or 2023 been a pre-seed investor, but just gone after every Series B round in a hot AI company, and that might have been better than pre-seed investing during that time. Yeah.
And then, like, what is the anatomy of like a good logo collection, like portfolio, if you will? Like, if you had to think about it from the now that you know what you know.
I think at any time in the tech ecosystem, there are like 10 to 20 companies that matter, that attract talent. Now, they may not matter in the arc of they may have a poor exit or not. But I think being associated with them does give you a cachet for a period of time that you can leverage with different audiences at different times. Yes. And it appeals to people like when they're making decisions, right? So it can work. Yeah.
Hey, Semil, I had a question on portfolio strategy construction, right? So you've mentioned 30 to 35 shots on goal in a fund. And then you had another comment about benchmark kind of going to 15 deals. And I'm wondering if you have a thought on that, on is there an optimum point? And is there such a thing as too little? And is there a thing as too much as a number of shots on goal?
No, because I think there are different strategies at work. Like we all know Ashmeet, right? And he's doing like 13, 14, 15 companies per fund. That was the intention going in, I think, and has worked for him and his style. Then you have something like Founder Collective, which is 4 partners, 95 million, and they're doing like a 3-year fund. They're doing 60, 65 names, right? So I think it just depends on like what you can manage, what the flow is like. Founder Collective does very few follow-on checks. So I don't know if there's an optimal number, really. I think we'll know in a few years. Like that's kind of the theme. No one knows anything right now.
And one more follow-on question to that. So, and how do you think about valuations that you're willing to pay? So let's say, and with all the crazy rounds that are going on where seed deals getting done at 400, 500, is there a point, no matter how much you love a deal, where you go, bang, I'm not doing this? Or how do you think through that?
It's probably lower than that, but I try not to think about valuation right now as much as that pains me to admit. I feel like right now we'll all be judged on selection within a certain range. And then some of the rounds that are 400, 500 posts to start, we don't play in that. Yeah.
Hey, question about your fundraising journey. Yeah. I feel like every GP has like a universe of LPs that sort of like vibe with who they are and what they're doing. So I'm curious for your like persona, like your style of investing, your fund size, everything about you. How would you characterize the LPs that like vibe with you and you kind of have a continuous relationship?
I can just tell you like what they tell me. No, what they tell me. But I don't know. Like I don't know. So take it for what it's worth. I think they appreciate that we don't try to make things too complicated. That we're not doing a lot of activities or stuff or events or podcasts and stuff. I think they appreciate the smaller size, of course. I think they know that like everyone on our team could make like double, triple, 10 times more in the marketplace if we left. So we're not doing it for that. So I think there's just some alignment there. And then like I've personally been pretty public about writing stuff, and so I think a lot of LPs feel like they're lied to or cajoled a lot. Yeah.
Well, with that, can we please give a big round of applause for Semil, and thank you so much.